Hey, it's Todd Ault and welcome back to Wall Street Words. Today's word is slippage. Now this refers to trading. When you're a trader or you are on the buy side, you run a mutual fund or institutional account, a hedge fund, and you give an order to a trader, there could be slippage in your order. Generally this happens when there's a large order and maybe there's not enough buying, so you go in at say $10 a share and the price slips to $9.75. The slippage is the difference between the bid and the ask and where the price was when you put the order in. Now this usually can also occur during high times of volatility. This slippage accounts for a lot of Wall Street usage when it comes to money and what they think they're going to get executed on, best practice for execution, etc. Slippage is important and it costs Wall Street a lot of money every single year. Trading volume, a lot of volume, slippage gets narrowed really quickly. If you look at Microsoft and you look at the bid ask, sometimes there's less than a penny between the two. Slippage generally happens when there's large orders or some sort of volatility taking place. Hey, on a side note, when I ran a hedge fund, we focused a lot on slippage. We used algorithmic trading to try to avoid that by being a little bit ahead of the offer and offering out prices at different prices to avoid putting orders all in at one time. Slippage can be very costly to a trader, very costly to a hedge fund. Today's word is slippage. Hey, thanks for watching Wall Street Words. Please subscribe and hit that bell below. If you think this video adds value, please share it with somebody. By the way, if you want to watch more Wall Street Words videos, there's 2 videos right here you can watch right now. There's new videos every day. Thanks for watching Wall Street Words. Always great things happening here.